Well, the Fed is now signaling that interest rates will stay higher for now as Americans keep grappling with those rising prices. Federal Reserve Chair Jerome Powell saying about inflation this: the recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. Now, this is the consumer price index rose 3.5% last month, well below the Fed's target of 2% inflation. Stocks have been trending lower in recent days as well, but on Tuesday, the Dow closed up slightly as traders suggest or digest this lower likelihood of rate cuts. Joining us now, senior economic analyst and Washington bureau chief for Bankrate.com, Mark Hamrick. Mark, it is great to see you. So, we all feel the pain of this. I see this in the grocery store. You see it at the gas pump. What is the effect? What is this having? What are the implications on consumers?
Well, first of all, the reason we have high interest rates is that is a central bank's primary response to high inflation. We all have lived that. We know what that's been like. Consumer prices right now are still 20% higher than where they were before the pandemic. And there probably is not going to be a lot of relief from that. So what the Fed is trying to do, you referenced the recent increase in the year-over-year showing with the consumer price index up 3.5%. The Fed's trying to knock that down in the sense of recent inflation. And we are seeing some deflation with goods. The bottom line is that people are aggravated by high inflation. They are not happy. They don't have the buying power they had before. That is real. And so when people like Jerome Powell say the economy is doing well, talking about the job market, talking about growth, there does tend to be a natural reaction on the part of people to resist that because their primary experience is the still elevated level of inflation.
Right. So let's talk about how that impacts how consumers react and then the ripple effect of this. So how are buyers buying differently and what is the outcome?
We hear from retail CEOs, grocery store CEOs, for example, that consumers, particularly in middle and lower income categories, are buying down. In other words, instead of buying the brand name can of beans, they're getting the store brand. Right. They're going to places like Walmart and Target and trying to find better value for their food purchases. The other part is that it's extremely expensive to borrow. We have mortgage rates at about 7% right now for a 30-year fix. That's compared to 3% in the early days of the pandemic. And so housing affordability is really kind of a nightmare. And the same is true for buying a car, and people are weathering the high cost of car insurance as well. So there are a lot of negative forces going on. The one big positive is that we still have a strong job market. Most of us are reliant on our jobs for our income and our personal viability in the sense of our money, and that's what we do have going for us.
All right, that's good. So I think the big question in all of this, when will we see some relief? Do you see any of this on the horizon anytime soon, Mark?
It won't be like a huge amount of relief in the sense of interest rates falling sharply. But the Federal Reserve is still signaling that its inclination is to cut rates later this year. Right now, it looks like we're going to have rates higher for longer and perhaps not as much rate cutting. If something happens where the economy really does slow significantly, that's in line with, let's say, a recession or economic contraction. That's when central bankers have to cut rates sharply. We're not wishing for that because we don't want a recession to get lower rates.
Right. So I have to ask you about this discrepancy. There were a lot of forecasts that would happen a little bit earlier this year. Why has that been delayed?
In the sense of rate cutting, it's because of inflation has been stickier than would have been thought. And a lot of things just are not the same this time around as they were in the past. And one of those things that's not the same is the fact that, for example, on mortgage rates, the majority of homeowners have a mortgage rate that is at 4% or below. And we're talking about those rates right now being at 7%. So even as the Fed raises rates, so many people are sitting pretty in their home with a rate that's lower. That doesn't have a huge impact on them. And so it's taking longer for the Fed's medicine to work. We think it will work in the long term, but unfortunately, it's requiring more patience for all of us. And maybe not all of us are great at being patient.
I'm certainly not. Mark Hamrick, thank you so much for being here. Always a pleasure.
Thanks for watching, everybody. Go to joinnn.com to find NewsNation on your television provider. Also, don't forget to click that red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.